Have you ever noticed that we all seem to know the rule, buy low, sell high?
Hmm.
But the second the market gets a little shaky, all that logic just it goes out the window.
We panic.
We do. We panic when things fall, and we get greedy when things are already way too expensive.
Which is why we're doing a deep dive into the source material you shared with us, specifically Parag Parikh's book, Value Investing and Behavioral Finance.
Yeah, and this book, it cuts straight to the chase.
Yeah.
Our mission today is really to explore his core idea
Which is?
that the biggest risk to your money isn't the stock market, it's your own mind. We're going to see how controlling your behavior is the real key to controlling your wealth.
Okay, so let's jump right into Parikh's central belief, which is kind of terrifying when you think about it. He says, investors don't fail because markets are risky. They fail because they are risky.
Exactly. It completely flips the script.
It does. It means the enemy isn't a recession or some big market crash. It's us. We are the ones introducing the danger. And that risk, it doesn't just come from nowhere. It's fueled by all the noise.
Right. Social media, news, that one hot tip.
And of course, the big one, the fear of missing out, FOMO.
The book has that perfect scenario. You've got this solid, rational plan, and then a friend tells you they just doubled their money on some random stock in 3 weeks.
And just like that, your sensible long-term plan feels slow. It feels wrong.
Yeah, and your discipline just melts away.
That's the moment. And to fight that, Parikh is really strict about what value investing actually is. It's not just buying good companies.
It's buying them at a discount.
A steep discount.
Mm.
So you build in what he calls a margin of safety. You're trying to buy $1 for, 50 cents.
So if it's that simple, just wait for a big sale? Why is it so hard for people to just sit on their hands and wait?
Because our brains are basically wired against it. Parikh points to 3 huge behavioral biases that get in our way. First, there's the herd mentality.
Following the crowd.
Right. We feel safe in a crowd. But the market, it almost never rewards the crowd. Independent thinking is where the real money is. If everyone's buying, a value investor should probably be selling.
Okay. And the second one, overconfidence. That one seems like it costs people money just through activity.
Oh, absolutely. Overconfidence is thinking you know more than you do. It leads to excessive trading, trying to time the market. And what does that do?
It just racks up costs.
It relentlessly racks up costs. You're paying this tax for being overactive, even if you're right sometimes.
So if overconfidence costs you in fees, I'm guessing the third one, loss aversion, does the real structural damage.
That's the crucial insight. The psychological pain of admitting you made a mistake and lost money is often worse than the financial loss itself.
So you hold on.
You hold on to these sinking ships hoping they'll come back someday. You're just stuck in denial. Real discipline is cutting your losses and moving on.
This all seems to circle back to time, doesn't it? Which brings up that great quote. Markets are voting machines in the short term, but weighing machines in the long term.
That's it. Time and patience create wealth, not speed. He uses this wonderful mango seed analogy. You plant a seed, you water it, but you don't dig it up every day to see if it's growing.
And investors checking their portfolios every hour are basically just digging up the seed.
Constantly.
So what's the practical tool then? How do we build that emotional discipline?
The best advice is to think like a business owner, not a speculator. I mean, if you owned a bakery, you wouldn't sell the whole business because the price of flour went up for a week.
No, of course not. You look at the long-term health of the business.
Exactly. That mindset forces you to ignore the daily noise and
Yeah.
focus on what actually matters.
So when you put it all together, it's a bit like driving in really bad traffic.
Hmm.
If you're impatient, always jumping lanes, honking,
Yeah.
you just create more stress and you probably don't even get there any faster.
But if you stay calm, stay in your lane, and focus on the destination, you get there safely. This book is, at its heart, a mindset reset. A calm mind is the best investor.
And a disciplined mind is the richest.
That's the real takeaway.
So here's the final thought for you to mull over. If the biggest enemy to your financial future is really you, then which one of these biases, herd mentality, overconfidence, or loss aversion, is the one you need to recognize and maybe start to eliminate from your own thinking starting today?